So many times somebody might finish residency or finish fellowship, and then they go get a life insurance policy. And 10 years goes by, and there's quite a pay gap from fellowship to being an attending for 10 years. There's a huge pay gap. So a lot of times you might even have like less than 1 year of income as life insurance for your heirs who are depending on all of your income.
Welcome to the MAdvisor podcast. I'm Paul Morton, a certified financial planner professional. The MAdvisor podcast exists to help busy professionals get an educated and clear vision about money. Talking about money is difficult enough as it is. Discover the confidence in creating a customized financial plan in a calm and casual environment. Not every professional should have the same financial plan. Everyone is different. Let's celebrate that. Every financial plan should be different too. Music used in this show is by the band Forum. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Inc., a broker-dealer. Member FINRA SIPC. Advisory services offered through Cambridge Investment Research Advisors Inc., a registered investment advisor. Cambridge and MAdvisor are not affiliated.
Welcome to the MAdvisor podcast. I'm Paul Morton. The MAdvisor podcast comes out on payday, the 15th and 30th of each month. Today we're talking about life insurance, but more specifically, we're talking about when should you purchase a life insurance policy, or when should it be updated or reviewed, and what does a quote-unquote review look like? So the first thing I think to understand is the concept of insurable interest when looking at purchasing life insurance. Insurable interest is basically the idea that you are more important alive than dead to somebody. And so insurable interest is necessary for an insurance policy to be generated or created, and it prevents immoral gambling. So an example of insurable interest is just people I don't know, strangers. If a stranger somewhere in the world is surviving or not, it wouldn't affect me at the moment, yet I care about people and I want them to do well, have fun. However, me owning an insurance policy on a stranger and somehow financially benefiting if they passed away would be a weird conflict of interest, and it would be some sort of immoral gamble that no ethical individual should be making. You have an insurable interest when you love somebody or you owe somebody money. Those are usually the two topics that would trigger the allowance of an insurance policy, a life insurance policy, to be issued. Also, if someone is dependent on you for support, that would trigger that ability to purchase a life insurance policy. Usually if someone's dependent on you for support, it falls under that you love somebody category and you care about them. And then also, if you depend on somebody else's efforts to run your business or to run an organization, that kind of falls under the owe somebody money if someone works for you and you're continuing to pay for them, to pay their salary. But that business effort, that key employee provision, that kind of falls outside of you owe someone money, and it falls outside of you love them, although you might really like and care about them. But it is one of those insurable interests that is a little bit outside the norm. And so here are some of the top reasons that someone might purchase an insurance policy. And of course, this isn't like the end-all be-all list, but First and foremost is when you get married. Now, this is not the most romantic topic to discuss. You get married and you go buy a life insurance policy. That doesn't sit well with everybody. I would suggest that if somebody is not financially dependent on each other yet, they maybe just got married, then it may not be appropriate to buy a life insurance policy. Not because you shouldn't, but it might just feel weird. So it might make sense to wait till you become more financially dependent before a life insurance policy is purchased. However, there are lots of individuals who have a family together, they own property, they buy a house together well before they're married, so they may be financially dependent on each other, even though they're not married. The second top reason, and in my opinion, this is probably the top reason, is when you have kids. That changes really the way in which you look at your own life. Or for me, it changed the way I look at my own life. I'm no longer just here to take care of myself. I am taking care of others who depend on me to survive. And so when you have kids, in my opinion, it's not an obligation to buy life insurance. I don't think that's a good concept to put in someone's mind or their thoughts, but we are obligated to take care of our kids. And one of those ways that we can take care of our kids is to make sure that they are financially secure, whether we survive or not. Of course, my kids would want me around, but if I wasn't around, it would be that much worse if they had to adjust their lifestyle just because I wasn't around. And having kids, that means, I think, a lot of different things. It could be you have kids by natural birth, congratulations, by adoption, congratulations, by marriage, congratulations. So it's not necessarily just you have a child. There could be multiple ways in which you have kids. And I think that it's all a first place tie that when kids enter your care, when kids are dependent on you, life insurance is then a discussion point. It doesn't mean you have to buy it. You're not obligated, but it should be a discussion point on your to-do list to see if that's something you should or shouldn't have. And then let's take this just one step further. Let's say you have kids and you have a spouse that really doesn't provide enough or maybe even any income. Should they have life insurance? And in my opinion, the spouse that doesn't provide income still provides economic benefit to the family. So if you have, let's just say, like a stay-at-home dad, the stay-at-home dad stays at home with the kids so that the wife or the spouse can go earn whatever it is they earn. They don't have to worry about what's going on with the kids and are they going to make it to the places they need to make it to, they need to show up to? Are they going to eat that day? Are they going to have fun? Are they going to have some sort of brain stimulation for that day and go learn things? And so if that stay-at-home spouse didn't exist anymore, they passed away, then that economic benefit of somebody caring for your children that deeply no longer exists. It's not just somebody watching those kids, somebody caring for your children in a deeper manner than, well, let's just keep them alive today, which is a babysitter. I think a babysitter is somebody who watches your kids and keeps them alive for a short period of time. Whereas a parent would be somebody who deeply cares about the core well-being and growth and trajectory and the implementation of your family values on your children. And so those are economic additions to the family that I think at least should be considered and discussed. If you take out a loan, a business loan, it could be a mortgage, whatever it may be, but if you take out a loan, then at that point it is, I think, at least a consideration to purchase a life insurance policy. Now, a bank, if you take a loan from a bank or a credit union, then they may require you to have a life insurance policy. And then you leave that life insurance policy, you place a collateral assignment on the life insurance policy. So if you die, if you pass away, then the loss payee or the bank who the policy is assigned to basically just gets the first rights of refusal to that death benefit. The beneficiary, the primary beneficiary, might be your spouse, but it's collaterally assigned to the bank. So if the bank has a $500,000 outstanding loan and you have $1 million policy, then the bank is authorized to take as much of the policy, as much as the proceeds to pay off the loan, and then the remainder goes to whoever the beneficiary is. It does not make sense ethically to name the bank or the financial institution as the beneficiary. There is no insurable interest for the bank to be the beneficiary of all the funds. The beneficiary should be named as a spouse, parent, somebody, but then the policy is just assigned as collateral so that the bank or the financial institution doesn't take the whole policy. They just take how much they're owed. And then lastly, a key employee. I don't want to spend too much time on key employees today, but if you have somebody who contributes to a business that you run in a way that it would be really difficult to replace their productivity, usually this is somebody who brings in revenue to your business, then it might make sense to have an insurance policy on that individual that you as the business owner or the business in general would be the beneficiary of. Now that employee has to sign off to say, yes, that's okay. And a lot of times what you would do if you bought an insurance policy on a key employee that benefits the business, a lot of times what you would do is you would buy an insurance policy on the employee so the employee can name their own beneficiary in addition to having the key employee insurance policy on hand. Not always, but a lot of times there would be like another benefit involved in that key employee life insurance policy. And then let's move on to when should you update it. Really, any of these reasons to purchase an insurance policy should also be a reason to update and review. If you have an existing insurance policy, I think once every couple years it should be reviewed. And then what does a review look like? I personally like to review it once a year. And in the review timeline really is at that, let's say the end of the year. Let's call it like October, November. It's when you're signing up for your benefits. It's when you're doing your retirement plans and doing all of your beneficiary reviews for your benefits at work. It just makes sense then to have a file. It could just be on your computer or some logins at an insurance company, whatever it may be, and just make sure that the beneficiary is listed how you want it to be. If you'd set up a trust and you didn't name the trust as the beneficiary for some reason, whether that's intentional or not, or you just don't know if you should or not, you could reach out to the attorney, or if you have a financial planner, reach out to them and make sure that the amounts of the insurances are okay. So many times somebody might finish residency or finish fellowship, and then they go get a life insurance policy. And 10 years goes by, and there's quite a pay gap from fellowship to being an attending for 10 years. There's a huge pay gap. So a lot of times you might even have like less than 1 year of income as life insurance for your heirs who are depending on all of your income in their foreseeable future. So you look at the beneficiary, you look at the amounts of the insurance and make sure that they're okay. And then usually when you have an insurance policy, most often it's going to be a term life insurance policy. So these actually run out of steam after 10, 20, 30 years, whatever it may be. And so just make sure that is okay. If you have a term life insurance policy, it's inevitable, unless you die while that policy is in force, it's inevitable that policy will go away. So you want to make sure that when that policy goes away, that's okay with you, and just notate when that occurs. If that's not okay, then you might need to layer that with a new policy that will last beyond that, or make whatever arrangements you need to make sure that that's going to be okay. But it's something that's almost always a surprise. We buy a 20-year term policy, and then after 20 years, it goes away. And it's almost always surprising that it goes away after 20 years, even though we knew that when we purchased it, we knew that every time we looked at it or talked about it. But in our minds, we just have life insurance, and we don't really have the idea of how it works grasped in our plan. And then aside from that, just when you review the life insurance policy, make sure your addresses are right, make sure the names are right, just make sure that everything's right about it. And then it shouldn't take more than just a few minutes to go over all of that stuff. Just a few minutes once a year during benefits enrollment time might play a huge role in your beneficiaries' lives, just to make sure that things are appropriately as they need to be regarding money, benefits, and how beneficiaries are titled. Thank you for listening. I'm Paul Morton with M-Advisor. M-Advisor helps physicians with their financial planning. You can visit m-advisor.com, and there's more information there. Once again, I really appreciate you listening and being here for the M-Advisor podcast.